I'm here to continue our discussion on a very interesting topic on of DuPont analysis. Basically, it is a tool for financial statement analysis, and it is very much used by management accountants, and at times, it is used by some other stakeholders also. And this is one of the most interesting and emerging topic of financial statement analysis. And since the name itself is indicating about some analysis with the prefix of DuPont, at times students are taking very much interest into it, that what kind of analysis it is, whether we call it DuPont or it is DuPont. Basically, it's a DuPont analysis which we are doing for financial statement analysis. It is being used by a specific company. It was basically, if you go to the history of this DuPont analysis, I'll tell you from where this name has been given to this analysis. I would actually be telling you briefly what is the background and introduction of DuPont analysis, how to calculate it, how to conduct this kind of analysis. I will tell you, I'll help you in understanding the tool and also its different versions. There are two different versions in place for you. So I would also be explaining to you what are these two different versions of DuPont analysis, and eventually what are the limitations of DuPont analysis, which means what DuPont analysis is not able to do, where it lacks. That also shall form part of our discussion. So with this agenda of telling you briefly about what is DuPont analysis, why we do so, I'm starting today's lecture on this topic of DuPont analysis. Basically, if we go to the background, the DuPont analysis, which is also known as DuPont identity, or sometimes you find it as DuPont model, it is basically a framework. And framework for what? We are basically creating a framework for analyzing the fundamental performance of a company. That whether whatever performance you are witnessing in terms of ROI, that is return on investment or return on equity, whether it is fundamentally strong or not, or if it is strong, what are the factors responsible for it? That is what we try to, or we intend to analyze in this framework of DuPont analysis. Here we try to understand and analyze the fundamental performance of a company, and it was basically popularized by the DuPont Corporation way back in 1920. So it's a very old tool which was popularized by the DuPont Corporation, and due to the name of that company, since this company analyzed or conducted this kind of analysis for the first time, that is why it is known as DuPont analysis in the name of that company. What kind of company it is, what it did, that also I'll be telling you. But see, DuPont analysis is an analysis of ROE. Basically, it's it's an act of decomposing your ROE, that is return on equity, and you are trying to find out the possible reasons or possible factors attributing to your the possibility of ROE, whatever you are getting. It is possible due to what factors and which factor has contributed how much. That is what is being explained by this very important tool called DuPont analysis. So one point is clear, that why do we call it DuPont analysis? Because it was actually popularized by a company called DuPont Corporation in the year 1920, and basically in that year of 1920, the American chemical and manufacturing giant DuPont Corporation, it created an internal management tool. To be very precise, it was actually floated by one of the salesperson of that company to characterize, to explain the reasons behind the ROE, whatever ROE company witnessed, whatever return on equity company witnessed, which factors were very prominent. That is what, whether the margin was very high, or it was due to leverage, or due to any other reason. So this analysis basically explained the possible reasons for possible factors for the possibility of this ROE, whatever company has witnessed, and to better understand the sources of operating efficiency and reasons for inefficiency, if any. This is a tool in the hands of management accountants, where they can understand if company is doing well, if my ROE is positive, what are the factors responsible for it, and not only that, out of those factors, which one is contributing how much, what is the magnitude of profitability, what is the magnitude of activity, what is the magnitude of your leverage in making that ROE possible. So that is what we intend to understand from this analysis of DuPont. It not only tells us about the possible reasons of operational efficiency, but also if there is any deficiency or there is any inefficiency, that also is equally explained by this analysis called DuPont analysis. So my dear learners, basically in DuPont analysis what we do, we are having a framework and we try to decompose the possible components of ROE, and that I am going to explain to you what it does. Basically it is very much useful technique to decompose the different drivers of return on equity. So before we start understanding the formula, the functional formula of DuPont analysis, we need to understand what exactly we do here. We actually decompose the different drivers, different components, different factors of return on equity. Now what is return on equity? Return on equity is basically the net income available to equity holders divided by number of equity shares. So shareholders wealth, whatever is shareholders wealth, you are trying to establish a relationship between the profit available to or net income available to equity shareholders and the capital which have been invested by the shareholders. So you can say that it is profit after tax divided by shareholders wealth, which means share capital plus reserve and surplus. And this decomposition of ROE basically allows investors also to focus on the key metrics of financial performance and individually to identify what are the factors which are positively contributing to which you can grow as strengths, and what are the factors which are negatively working for this, or what are the factors which are not contributing much into this ROE to which you can call as weaknesses. So basically we are on a drive to understand that whether my ROE, if my ROE is suppose 10%, it is possible due to which factor, and if all factors are present, which factor has contributed on the higher side, which means it has become our strength, and which factor could not contribute as per expectations, and that will eventually become our weaknesses. So once we identify what is our weakness, we can work on that, we can take corrective steps, and obviously we can improvise our ROE, that is return on equity. So what is the managerial implication of it? That is more important for us to know before we go ahead with the formula. Managers may basically use this analysis to identify the strengths and weaknesses which must be addressed by them well in time, well in advance. Otherwise what will happen if you don't adhere to those problems which are pertinent, which are persisting and contributing negatively to your ROE, or you can say your ROE is not getting on the higher side, you are not ensuring the return on equity to be on the higher side. Obviously it will become very difficult for you to retain and regain your investors, specifically the equity shareholders, because if they are finding the better option somewhere else, they will not stick to your company. So we need to understand as a KMP, or I would call as key managerial personnel of a company, we should know as a CFO, we should conduct this kind of analysis, that in my ROE, which component is contributing on the higher side and has become our strength, and which factor has not contributed properly, and we must see that with some slight improvements can we convert that weakness into our strength or not. That is basically the managerial implication of this DuPont analysis. And obviously apart from the management, other parties can also make use of it. Sometimes even salespeople, they are making use of it internally. They can say that, see, in your ROE the maximum contribution is from our side, so they can basically negotiate, or they can basically talk about their incentives, their ESOPs, what you call as employee stock option plans also, that yes, since we have contributed positively, the company must think about the employees also. But that is an you can say additional benefit of this DuPont analysis, but to be very precise, it is being used by the management with greater intensity, because they want to know what are the factors contributing to ROE. Even investors can also use to compare the operational efficiency of two similar firms. Suppose if I am actually acting as an investor, I can conduct the DuPont analysis of two companies. I can understand that whether the margin is contributing on the higher side, or it is due to leverage, the ROE is on the higher side. That is what we can do. So what is ROE? So you must be understanding that in all my introductory discussion, what I am saying that we are going to decompose the ROE. or we are going to segregate the different components or drivers of return on equity. So before going ahead with that decomposition process and segregating those components or drivers which are making ROE possible, we must know what is ROE. ROE is basically return on equity, and we can calculate it with the help of this formula, profit after tax divided by shareholders fund. Even suppose if you are having if your company is having some preference shares also, then in that case it will be profit after tax and preference dividend, or you can call it as net income available to equity holders divided by shareholders fund. If you want to calculate it in terms of percentage, multiply it by 100, you will get ROE in terms of percentage. Now this ROE, which is if you have a glance at it, you find it as a ratio between the two component, a relationship between the two component. One is profit after tax, another is shareholders fund. But we need to understand what are the factors contributing to this ROE, and that is what is basically the point of analysis under this tool of DuPont analysis. So what we are doing here, we are basically breaking down the ROE into its constituent elements, that whatever constituent elements ROE has, we have to break them down and find out that what is my which factor is contributing on the higher side and which one is not. And the best part of this analysis for you as a student is that when you are attempting it, you know that whether I am going in the right direction or not. Because since you are breaking down this ROE into different components, so it becomes a functional formula. So left hand side must be equal to the right hand side, or you can say exactly equal to right hand side. If you get the same rate of ROE after breaking it down, then obviously your calculation is correct, otherwise not. So since I am breaking down the same thing, or you can say I am segregating the same thing which was aggregated earlier, I am trying to segregate it, obviously I should get the same answer. So it is helping us as a learner to understand the reasons for an increase or decline in the ROE by identifying the underlying variables, that whether if my ROE has increased in relation to vis-a-vis last year, what can be the possible reason, which factor has contributed for this increment, and if it is opposite, if it is vice versa, there is a decline in your ROE, then too we need to know which factor has negatively contributed or which factor has not contributed as compared to the previous year, and then we can take corrective step as a management accountant. So now it's time for us to know that what we do, in what manner we are going to decompose or break down the ROE into its constituent elements. You find it an equation like this, where you are multiplying three component. We in DuPont analysis, we are actually taking it as a three component analysis, where we take profit margin as first component, we take total asset turnover ratio as second component, and financial leverage as third component. Basically these three are ratios again. So ROE is being decomposed or broken down into or segregated into three different steps. We call it as profit margin, total asset turnover ratio, and financial leverage. So we are trying to explain here is that my ROE is possible due to three components. First is my profit margin. My company is making good amount of profit. It is basically net profit upon sales into 100. So my company is having a greater margin, and that is why this ROE is possible. This is the first component. Second is, what is my total asset turnover ratio? So the relationship between my total asset which we have created with that of my sales, that suppose if I have created a total asset of 10 crores and my sales is only say 10 crores, then my turnover ratio is 1. So it is equal to what asset I have created, and this total asset turnover ratio is supposed to contribute on the higher side, obviously, because if you are not able to increase your total asset turnover ratio, it means your company is not that active as it is supposed to be. So you can call this component as the activity of the company. So first one is profitability, the second one is activity, and third one is talking about the financial leverage. So in a way you are taking components from all three segments, solvency, activity, and profitability. We are taking profit margin, we are taking TATR, that is total asset turnover ratio, and then financial leverage. And if you show it with a formula, now if we take the formula of all three components, the first formula for profit margin can be profit after tax divided by sales. And since all these components are having a relationship of they have multiplicative relationship with each other, so they need to be multiplied. So profit after tax divided by sales, that becomes the formula for profit margin, multiplied by TATR formula, sales upon total asset, into financial leverage, total asset upon shareholders fund. Now if you look at these three components, the DuPont analysis, what it did while framing this equation or creating this framework, what it did, it actually said that these components are having are sharing multiplicative relationship with each other. So if any one of the component is giving you the answer of 0, then obviously your ROE or your even your end you can say your outcome, your end result is going to be 0. So we have to understand, we cannot afford to have any component to be 0. So the value 0 cannot be there, it should at least be 1 or more than 1 it is supposed to be. So this is the formula. If you look at this formula closely, you find that since they are having multiplicative nature, what you can do is, if you look at profit after tax upon sales into sales upon total asset into total asset upon shareholders fund, eventually if you solve this formula, you get the basic formula of ROE, that is profit after tax upon shareholders fund. And at times learners, what they do while attempting this question, they don't solve it, they actually cross all those items, sales to sales, total asset to total asset, and eventually give a formula profit after tax upon shareholders fund. And the moment you do that, you defeat the very purpose of conducting this DuPont analysis, because my purpose is not to calculate ROE, because ROE is already there. My purpose is to know which factor has contributed much, whether it is profit margin or it is TATR or it is financial leverage. So you have to find all three values separately, and then you have to say that, see, this is the end result of this is giving me the end result of ROE, but profit margin out of, say, a total value of 1 of ROE, whether profit after tax is contributing 50%, 40% or 30%, whatever it is, we need to indicate, so that the management should be aware that this time ROE is not because of profit margin, it is because of leverage. Or this time profit is not because of only profit margin, the significant contributor has been total asset turnover ratio. So it is due to your total asset turnover, and your turnover is on the higher side, which means your sales people should get the benefit. And when this analysis was conducted for the first time, it was a salesperson who introduced this very decomposition of ROE, that, see, in your ROE we are the greatest contributor. So the three components which we have discussed here, they are supposed to be multiplied with each other to generate ROE, and that is what we have to do. If you try to understand the flow, if you look at the flow of this DuPont analysis, you find that there is a net profit margin, there is asset turnover, there is financial leverage, and all three formulas, they are multiplied with each other. So if you look at the stricken out items, that revenue has been stricken out with revenue, and average total asset have been stricken out with average total asset, eventually what you find net income upon shareholders equity. In some numerical problems, you will find the average value. There you take numerator and denominator from the average segment. Otherwise normally we take the net revenue, and we take revenue, we take total asset, we take the shareholders equity. If average value is given, then definitely we have to go by average value. This is what I wanted to show, that some students, they strike out these common values, revenue with revenue and total asset with total asset, and say that, see, in DuPont analysis formula is the same. Yes, we are not denying to the fact that the formula remains the same, but we have to calculate that value of net profit margin. Say, suppose if you divide net income by revenue and you find a value of 0.50. So it means out of total value of, say, 10% or 100 or 1, 0.50 is being contributed by net profit margin. Suppose asset turnover is giving 0.4, you are getting a value of 0.4. So asset turnover has contributed to the extent of 40%, and financial leverage has only contributed to the extent of 10%. So company will understand, the management will understand that, see, we are not having financial leverage here, we are not able to magnify the impact of fixed interest bearing source of finance on our total profitability, and it is the profit margin and asset turnover which has contributed. So the purpose is that you should know that out of these three components, which has contributed on the higher side and which has contributed on the lower side. Now if you try to understand the equation, you should know that it is basically a function of three component, or you can call it as three ratios. One is net margin ratio, another is total asset turnover ratio, and last one is financial leverage, or we also call it as equity multiplier. And I have shown the formula of all three, that it is total asset upon shareholders fund, and these three components are going to contribute to your ROE. And the third component basically depends on the presence of debt in your capital structure. Now you must be thinking, what if my company doesn't have any debt into the capital structure? I'm an all equity company and there is no financial leverage into my company. Even when you say there is no financial leverage, your financial leverage will come to be 1. So if there is no debt into your company, then obviously you are what kind of firm? There are two categories, levered and unlevered. So you are basically an unlevered firm where there is no leverage, and then to your value will not be 0, it will come to be 1. So the third component can only contribute when your company is having debt into its capital structure, or you can say that when you are a levered firm. If you don't have leverage, then obviously if you are an all equity company, then these first two components, that is profit margin and turnover ratio, that is activity ratio, that is going to contribute to your ROE. So at times in your interview we ask a question that in DuPont analysis, suppose if you are an all equity company, what role this financial leverage will play? Answer is no role, because there is no leverage into the company. Financial leverage is 1, which means there is no leverage. So for a zero debt company, that is why I am telling you specifically, if you are a zero debt company, which means you are an all equity company, the financial leverage will be 1. It will never be 0, because sometimes students they intend to answer that, see, financial leverage will be 0. No, because your all asset have been funded by the shareholders fund. So if your numerator and denominator, which means your total asset and your capital, they are the same. So due to the absence of leverage, what will happen? Numerator and denominator both are the same. So the third component is going to give you the value of 1, and when you multiply something with 1, you get the same value. There is no contribution. So here what you can do is, in such kind of company as a management accountant, what is left for you is that you can increase your ROE by increasing your net margin, or by trying to increase your turnover rate, so that your profitability may improve. And at times by improving your cost also. Obviously, in any case, if you control your cost, your profit is going to increase. You may offer higher margin, high margin value added products and services to your customers, so that your sales may increase. Because you cannot get the benefit of leverage, unfortunately, because you are an all equity company, you don't have any debt, so there is no point you getting any benefit from the financial leverage, right? And what if you are an equity company, you are having a company which is having debt and equity both, then obviously leverage can also work. So the asset turnover can also be improved by using the asset more efficiently. You can go for expediting the collection process of your trade receivables. You can go for having efficient turnover of inventories, and there are many other ways to improvise your first two components, right? Now, what is the benefit of financial leverage? If you are having a judicious mix of debt and equity, then obviously you can contribute. It can contribute positively to your ROE. ROE can be increased. For instance, suppose if I take example of an enterprise which is having a low margin business, which means low margin means it is only having a net margin of 5%, making a profit of 5%. Its asset turnover ratio is of 2 times, and financial leverage is of 3 times. So if you have a look at the net margin, it is only 5%, but asset turnover ratio is 2 times. Financial leverage is of 3 times. So if I calculate its ROE, I'll multiply all 3. And this is going to give me a result of 30%. You must be thinking how this 30% is coming. 5% into 2, 5 2s are 10, 10 into 3 is equal to 30. So you can imagine here the power of this financial leverage and turnover, that your margin of 5% is resulting into 30% of ROE. So it is not your margin only which is contributing to your return on equity, but other components also. This is what this DuPont analysis intended to tell us. Now there are two versions of DuPont analysis. One is 3-step, which I have already explained to you. Another is 5-step analysis, which is also available. And in 5-step analysis, there is not much change in terms of calculation. In 3-step version, I told you what we do. In 5-step version, what we are doing here, there are two components which are introduced. One is your tax, another is your interest income. So in 5-step analysis, the formula is like this: you take net income and divide it by pre-tax income, then revenue and total asset and shareholders equity, pre-tax income and operating income, and eventually operating income and revenue. So there are basically three in 3-step equations. You are having only 3 components. In 5-step equation, you are increasing the tax burden, proportion of profit which is retained for taxes, or you can say the proportion of profit which is being paid as tax. So tax burden and interest burden, that is something which we have to consider when we are going as per the 5-point version of this DuPont analysis. Some people ask that which one is better, DuPont analysis or ROE. Both are not complementary to each other. They are basically used with different purposes. So ROE is basically a net income divided by shareholders equity, whereas DuPont analysis is going to explain to you what are the factors contributing to this ROE calculation. So ROE calculation will only reveal you whether your ROE is 20% or 30%. It is not going to give you the reason, and for that you have to go for DuPont analysis. So that is the benefit of DuPont analysis, and I hope you must have understood what we do into DuPont analysis. I won't say that it is devoid of any limitations. There is some drawback. The drawback of DuPont analysis is that it is, when you are going to expand or decompose your components, it is still relying on the data provided by the financial accountant. So you are not doing anything new. You are basically trying to decompose or segregate whatever you have already done. So with this, we have come to the end of this discussion on DuPont analysis. I hope you must have understood and enjoyed this topic of DuPont analysis. Thank you so much.